silver will go to 500, gold will go to 20,000. So that's what, in real terms, when I say 25% inflation by early next decade, in real terms, that's what it'll translate into commodities. And obviously, commodities flow through to consumer goods and everything else. So the consumer is going to be facing some tremendous headwind. Standard of living is going to be hit pretty hard, I think. Hopefully, I'm wrong on some of that in terms of the extremes. Hopefully, Trump has some policies that can, ameliorate some of that. Some of their plans to, try to reduce the deficits.
In the 1970s, the U.S. experienced double-digit inflation, accompanied by a gold bull market. Indeed, gold prices increased in the 1970s, when the inflation rate was high and accelerating, while they decreased in the 1980s and 1990s, when the inflation rate was declining. Gold prices achieved a historic milestone in 2024, surpassing their inflation-adjusted peak from 1980, marking a new all-time high in real terms, according to a report by DSP Mutual Fund. While gold has firmly entered a bull market, silver continues to trail behind, yet to revisit its inflation-adjusted highs from 2011. Financial market specialist DavidHunter warns that current AI hype distracts from the real story, an imminent macro bust triggered by extreme leverage. He predicts a massive monetary and fiscal response will drive inflation above 20% in the U.S., with commodity prices skyrocketing gold to $20,000 and silver towards $500. He believes that macro forces will override all other narratives, including those driven by AI and political shifts. Looking at the current market, Hunter remains bullish on gold and silver, predicting gold will reach $4,000 by year-end. He sees gold's recent consolidation as healthy with limited downside. Despite silver's volatility, he believes August will be another strong month for both metals. Silver has recently broken above a well-defined parallel uptrend channel that had contained price action since the 2022 lows. This technical breakout is particularly significant as it occurred with strong volume and has been followed by consolidation above the previous channel resistance, now acting as support. Silver is approaching critical historical resistance levels around $50, which represented major peaks in both 1980 and 2011. Technical analysis suggests that a decisive monthly close above this level would signal a major breakout from a decade-long base formation. In his outlook, Hunter also notes that silver miners are in clear uptrends despite volatility. Overall, Hunter remains constructive on both metals and mining stocks. Silver mining stocks have shown particular strength recently, outpacing both the broader market and physical silver in percentage terms. The Global X Silver Miners ETF has gained over 50% in the past 6 months, outperforming silver's 45% increase, which demonstrates the operational leverage inherent in mining equities. Before we dive into DavidHunter's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
I remain bullish on both gold and silver. Gold actually has done a nice job of consolidating since April, basically a 3.5-month consolidation here at a high level, between, 3,200 and 3,400, 3,500, I guess. And at the present time is more in the lower end of that consolidation. I don't think there's much downside here, if any. And I think basically you'll have another leg up here. I have a 4,000 target on gold. I can't remember exactly when I raised it, but since I talked to you last, I think I raised it from 3,400 to 4,000. And I think that's what we're probably going to see this year. So sometime between now and the end of the year, you should get up to that. Silver's a little more volatile, as we know, and scares people out oftentimes because of the volatility. It ran to $39 and looked like it. I think my next resistance level is the mid 40s, 44, 45, and not sure what it does there, whether it has a bigger pullback or kind of very short term stalls out and pushes through there. My target on silver is 75. We could see that by the end of this year or certainly early next year. And I don't view this sell-off as violent as it may seem to some that we've come back from 39 down to 36 and change. A month ago, back in early June, silver was down in the 33.5 area, 33.25 area. So we're at the end of the month. It's the last day of the month. It's not unusual for these metals to fill in, and actually other markets too. So people have to be careful not to react to day-to-day stuff. If your low last month was 33.25 and you're at 36 and change now, and your high last month was lower than the high today, you're still putting in higher lows, higher highs. And I think August will probably be another bullish month. So silver looks great to me. I think the miners are finally, although they are again volatile and cause people to get nervous, they're in uptrends that will continue. And my targets for silver are SIL, which is large silver miners, to 75. I think that's on track. And SILJ to 35, which is a long way from here, but I think you could see that this year. So on gold, GDX, I raised my target, had been for a long time 65. I've raised that to 75, and my GDXJ, which is junior miners, remains at 100. It's a very clear target there that I think we can get there a little above that. So I remain very constructive on both the metals and the miners. I mean, there's an awful lot of speculation and valuation being driven to the sky on some pretty rosy expectations. And a lot of those expectations obviously won't play out in the short run. AI is certainly here to stay, and AI will contribute to whatever the next cycle looks like, hopefully positively. But my big thesis is, as I say, the macro trumps all of that. And the macro is this huge leverage that takes us down sharply and leads to a massive responsible fiscally and monetarily beyond anything we could ever have seen, we've ever seen before and could ever imagine. I'm using, just as a seat of pants number, say 20 trillion out of the Fed in QE, new QE, that will take to pull us out of the tailspin. And proportionally similar from all the central banks. We did we were up to 9 trillion. We did from 3.7 to 9 trillion in the 2020 response, and prior to that, in the 2008-9 response, we went from 875 billion to 3.7 trillion over a course of several years. So that to say that we're going to go from we're basically 7 trillion now, I think, to go from there to 30 trillion, let's say, in response to this downturn, it shows you how much further beyond, and again, I could be wrong, but that's kind of what I see building up. And those kind of numbers, we use trillions, like we used to use billions, like we used to use millions, but those are huge numbers that we have never, ever seen before. They blow away anything in terms of proportionally anything we've ever seen. So what it means is that's the huge story. AI will be a sideshow to that, although AI will play a role next cycle. That macro, that massive and that massive money will be accompanied by maybe not as big as that, but a pretty massive fiscal response. That means debt's going to go even higher next cycle, as we come out of the bust. So you could be, we're at 330 now, we could be at 450 or 5 by the end of the decade, 500, from 330 to 500 trillion in debt. I mean, those are numbers we throw around, but they're mind-boggling. They're beyond anything that can really comprehend what that means. So it's hard to see where AI can compete with money of that magnitude or fiscal spending of that magnitude. But AI, I think, will be a productivity enhancer. So that's a good offset to what I think this massive money is going to lead to with a lag. It's not going to happen in 27. It's probably, you're going to see the bulk of the inflation late this decade, 28, 29, 30 and beyond. But I think what it ultimately leads to is inflation above 20%, maybe 25% in this country, hyperinflation around the world, and debt that has to be financed with interest rates that will follow the inflation. So if rates could get to zero, the 10-year could get to zero next year in a bust. If they start at zero, they could go to, if inflation goes 25%, The 10-year could go to something close to 20%, high teens to 20. How in the world do we service massive debt that we'll have as a result of that? That's why I say macro trumps everything else, even trumps Trump, because his pro-growth policies are going to give us some of that boom, but that boom's going to come with huge commodity inflation. As we build factories and plants and equipment here, it's going to require a lot more commodity input than we have supply for. And that means you're going to have demand way outstripping supply and prices going through the roof. Just oil, which is a favorite of his, obviously. And I think we're in a bear cycle in oil. I think oil goes to $30 in the bust. But from there, I think oil can go to $500 by early next decade. That's what inflation means. That's in real terms, that's what you'll see. You'll see copper go from maybe, $1 or $2 in the bust to, who knows, $20, $30. I don't know where copper goes. Silver will go to 500, gold will go to 20,000. So that's what, in real terms, when I say 25% inflation by early next decade, in real terms, that's what it'll translate into commodities. And obviously, commodities flow through to consumer goods and everything else. So the consumer is going to be facing some tremendous headwind. Standard of living is going to be hit pretty hard, I think.
After every major fall, like the one in the early 1800s or during the Great Depression in the 1930s, there was a big rally in commodity prices. For example, after the U.S. Civil War, commodity returns jumped to nearly 8%. Then, during the Long Depression, and again during the 1930s, the returns went negative. But in each case, the downturn was followed by a long upward cycle. Based on fundamentals, DavidHunter defines the current supercycle as the period from the 1930s depression to the next, likely in the 2030s. He says we're now in the volatile final phase, marked by extreme leverage, reactive policy, and growing systemic risk. He argues that the Fed is fighting the last war, too slow to ease and blind to the coming bust. Ultimately, he predicts a delayed but massive QE response of potentially $20 trillion to stabilize a global financial freefall. Interest rates were left unchanged at a range of 4.25% to 4.50% by the Fed at its policy meeting ending 30 July. This was the fifth meeting in a row where rates were left unchanged, and it comes against the backdrop of an uncertain economic outlook, given recent changes to U.S. trade policy. Since 1 April 2025, the Fed has adjusted its quantitative easing program by reducing the pace of its asset sales from $60 billion to $40 billion per month. Let's get back to the interview.
We're in a super cycle. I define a super cycle as that period between the last depression and the next one. I think the depression was obviously the 1930s. The next one is the 2030s. Not 2030, but the 2030s, probably 2034 or 5, maybe 2033, but not before that, probably. So what happens in a super cycle is kind of what I was describing before. The cycles get steeper as you go. And now we're in certainly the last decade, maybe the last 7 or 8 years of a super cycle. And so things are getting far more volatile, far more violent. There's far more excesses in the system, and it requires far more in terms of policy response. And that's why, people take to task Fed chairman, the last name, Janet Yellen before her, Bernanke, and, what Bernanke did in response to the, Great Recession and the huge financial crisis, biggest financial crisis we had to date in history. He had to do some of what he did to get us out of it. Yes, in hindsight, probably stayed on the zero interest rate policy for too long, and led to the inflation in 2022, et cetera. Interestingly, all of that is what feeds into the bust, because you've now got a Fed who is fighting that last war. They don't, they got beat up pretty badly in 2022 for not foreseeing the inflation that we got. They thought it was transitory, and so they kept their policy pretty much intact and then had to scramble to catch up to it. Now, some of that was driven by oil, spiking during the invasion of Ukraine by Russia, we went from 85 to 130 on oil overnight. So some of that was, obviously investors and market traders are not patient people. So when something happens right away, they want to, play the blame game. They want to extrapolate things out. And so they decided it wasn't transitory, that, the Fed was wrong about that and they should have anticipated it. So now you've got Powell and the Fed who are fighting. They don't want to make that mistake again. They take that criticism to heart and they go, this time we gotta take seriously any uptick in inflation. We got to make sure we've wound out inflation before we go the other way. So while some people think he's being political, and I can't say he isn't to some extent, it certainly doesn't help when, whoever you are, if somebody calls you a loser, you're probably going to take a little bit of that personally as much as you try not to. So my gut is that most of what he's doing, because it's backed by most of Wall Street and it's backed by most of his committee, is based on this idea that we don't want inflation. We don't want to move too soon and then have to be right back here in a few months fighting inflation again and in a more difficult situation. So I think that's mostly what's driving him. I personally think they're late, as the Fed always is in each cycle, because of the leads and lags. They wait and they're looking at backward-looking data, and by definition, waiting for that to give them the signal. That means they're going to be late because of a lagged policy of 6 to 9 months at least. So that means you're almost guaranteed to be late by at least 6 or 8 or 10 months. And so I think they should be cutting here and beginning to rebuild the balance sheet, as crazy as it is at the levels we're at. However, I can't fault him yet, because basically so far they've been right to sit on their hands. So, but that is what I think could be part of the bust, is they're going to be even later than they would otherwise have been, because of what happened because of the criticism they got in 2022 and because of what happened in response to 2020 and, having to put so much money in. He's stated over and over, I'm not going back there. We are not going to repeat the mistakes of the past and go to zero interest rate policy. I chuckle because he doesn't realize, if I'm right, they will be back there, not by choice, but because there won't be a choice. They'll be pumping in money to save the system because it'll be in free fall. What will get money up to the levels I'm talking is a banking system around the world that's failing, that's in free fall, bigger than what we saw in 2008-9. And they can talk all they want right now about what they want policy to be and what they plan to do. When you're faced with a crisis that's right in front of you, that is bigger than anything the world has ever seen, you are not worried about what does our policy lead to down the road, inflation 3 years down the road. You're worried about the here and now. And they're going to start slow. And that's where I think this, fighting the last war comes in. They're going to start slow. Slow now, meaning they should be cutting, but they're not yet. Slow later, meaning, we now need to turn things around. We need to ease, but they're not going to ease fast enough. So they'll, and I'm talking about money more than rates. You'll see them say, okay, we'll do $1 trillion, but we're not going back to $5 trillion, and we're not doing what we did in 2020. And $1 trillion may be $4 trillion too little at that point in time. They wait a month or more, and things are still in free fall. So they say, we got to do more. We hate to do this, but we don't have a choice. What else? We don't have any other tool. So they do another 2 or 3 trillion or whatever. And that doesn't do it. It will take them several steps and several months to get to 20 trillion, to a level or to whatever level it turns out to be, that is the right size policy that finally stabilizes things and gets things turning the other way. So everybody thinks it's a matter of, when the Fed eases, you stop the cycle, you stop the downturn or stop the free fall. No, it's not only turning the policy around. It's right-sizing the policy. And because of what's happened in the last 15 years, 2008, 9, up through 2020, it means they're going to do the wrong thing at the wrong time. They're fighting the last war. They will get to it because they won't have a choice. And I'm not in the Austrian camp or the Peter Schiff camp that this is the big one. We go into a bigger depression. This is a bust. And it's a bust because they do have the printing press. It's a bust because we will have, I think, deflation in this bust, certainly low inflation and maybe deflation in this bust, which means they'll have the wherewithal to print money because the inflation in response to that money is at least a couple of years away, maybe 3 years away in terms of real inflation, big inflation. If you're coming out of deflation, your first year you might go to minor, low-level inflation. Second year might be mid-single digit or a little higher inflation. By the third year, you're in double-digit inflation and you got problems. But when you're in the midst of a free-falling financial system and an economy that's tanking, you're not going to be worrying about inflation. You're going to be fighting that war. But for a while, they'll not see that that's what they're facing.
A combination of geopolitical shifts, financial instability, and technical market dynamics has driven the surge in gold prices over the past year. While central bank purchases and Asian investor activity have been the primary drivers, other factors, such as inflation, bond market concerns, and technical breakouts, have also played a crucial role. Silver, despite modest gains, remains significantly below its inflation-adjusted peak from 2011, when it touched an equivalent of $46 per ounce. As of 2024, it continues to lag gold's momentum, highlighting a divergence between the two metals. If gold and silver are poised for explosive gains, are you prepared to capitalize on the breakout? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.